Now let me ask you, have you ever averaged down on a loser? Added more just because it dropped? That's another killer. I don't average down. Ever. Why would I? If I'm wrong, I'm wrong. Why throw good money after bad? But traders do it every day. They think they're being smart, lowering their cost basis. What they're really doing is tying a noose around their necks. And do you know why they average down? Because they can't admit they're wrong. Pride. That's another big reason traders fail. Pride won't let a man take a small loss. Pride whispers, hold on, it'll come back, you can't be wrong. But the market doesn't care about your pride. It'll take every last dollar you have while you cling to it. Pride has no place in trading. The market humbles every man eventually. The sooner you learn to bow to it, the better off you'll be. Another thing, most traders don't think in probabilities. They want certainty. They want to know for sure what will happen next. But the market doesn't give certainty. It gives odds. That's all. And your job is to play those odds. A trader must learn to think like a poker player, not a fortune teller. But instead, most folks try to guess the future, and when they're wrong, they get mad, they get stubborn, and they double down. Do you see the trap? There's also the matter of capital. Most men come to Wall Street undercapitalized. They're trying to trade with money they can't afford to lose. Rent money, grocery money, borrowed money. That's a death sentence. The market demands respect, and you can't respect it if you're desperate. Desperation makes you weak, makes you break your own rules. Tell me, if losing one trade means you can't pay your bills, how on earth are you going to think straight when the ticker goes against you? You can't, and that's why the market eats you alive. But let me be plain, even men with enough capital fail. Why? Because they think the capital is the key. It isn't. The key is control of yourself, your emotions, your greed, your fear. The capital only magnifies your weakness if you don't have discipline. I've seen millionaires ruined faster than bootblacks, just because they thought their bankroll would protect them. It doesn't. Now, think about this. Why do you trade? Is it for excitement? For the rush? For the story you can tell at dinner? If so, you're doomed already. Trading for excitement is the quickest way to the poorhouse. The market isn't a casino, though most treat it like one. The market is a business, and if you don't treat it like a business, serious, methodical, planned, you'll end up like every other thrill seeker who thought they could beat the game. Another big reason traders fail: they chase the market. They can't wait for it to come to them. They see a stock shooting up, and they jump in, scared they'll miss it. Or they see it falling, and they sell, scared they'll be left behind. That's chasing, and chasing is suicide. You can't catch a moving train without getting hurt, but fear of missing out is stronger than reason for most men. Have you ever felt that itch, that I can't miss this one feeling? That's what ruins you. I'll tell you plain, the best trades I ever made weren't the ones where I rushed in. They were the ones where I sat and waited, like a hunter in the woods. The market always comes back to give you a chance if the move is real. But most traders don't have the patience to wait. They want action now. And so they lose. Another mistake: traders try to pick tops and bottoms. They think it makes them smart to buy the lowest tick and sell the highest tick. But that's a fool's game. I don't pick bottoms. I don't pick tops. I wait for confirmation, for the market to show its hand. That means I miss the first part of the move and the last part, but I take the big middle, the safe middle. That's where the money is. Tell me, would you rather brag about catching the very bottom and risk being wrong, or quietly take the fat profit in the middle and stay rich? Most men would rather brag, and that's why they go broke. Another reason traders don't adapt: they trade the market they want, not the market they're in. They cling to old ideas, old patterns, even when the market shifts. But the market changes all the time. What worked yesterday may not work today. The smart trader adjusts. The fool insists the market must come around to his way of thinking. And the market, being what it is, doesn't even notice. Do you see now why the odds are stacked against most traders? It isn't because the market is rigged against them. It isn't because the professionals have some secret the little guy can't get. It's because most traders don't have the patience, the discipline, the humility, or the control to play the game the way it must be played. They sabotage themselves. They're their own worst enemy. Think of it this way. The market is like the ocean. You can't fight it. You can't argue with it. You can only ride the waves it gives you. But most traders jump in with no training, no preparation, and they drown. And here's another truth that hurts. Most traders fail because they can't sit tight. They think the money is made by buying or selling, but the big money is made by sitting, by being right and sitting tight. That's the hardest lesson of all. Anyone can buy, anyone can sell. Few can hold. Few can wait. Few can do nothing while the market pays them. And yet that's the whole secret. But sitting tight is torture to most men. They can't stand to see their profits fluctuate. They watch every tick, every uptick and downtick, and it eats them alive. So they sell too soon, or they move their stops, or they second-guess themselves. Do you do that? Do you watch every tick and let it drive you crazy? That's the very reason you can't make the big money. Hope and fear, those two little words, have ruined more traders than any crash, any panic, or any war ever did. You might think it's the ticker, the news, the operators, or even the market makers that put a man under. But I'll tell you straight, it's not. It's hope and fear. They're the twin devils in every trader's heart, and if you don't get rid of them, or at least learn to control them, you'll join the 99% who fail. Now think about this for a moment. When a stock goes against you, what's the first feeling that rises up inside? Hope. You hope it'll come back. You hope the market's wrong. You hope you'll be saved from taking a loss. That hope keeps you from doing the one thing that would actually protect you, selling. You don't sell because hope whispers, hold on just a little longer, and the longer you hold, the deeper you sink. Do you see how dangerous that is? Then there's fear. When the market goes in your favor, when your stock starts to climb, what happens? You don't trust it. You get scared. You think, what if it reverses? What if I lose this profit? Fear makes you sell too soon. You cut your winners short. Instead of sitting tight and letting the trend pay you, you snatch at crumbs and run. Tell me, have you ever sold a winner only to watch it keep going without you? That's fear. So here's the madness of it. Traders do the opposite of what they should. They hold on to losers out of hope, and they cut winners out of fear. It's upside down, and yet it's the most common behavior in the market. That's why almost everybody fails. They don't fail because they can't pick a stock. They fail because they don't know how to handle themselves when they're right and when they're wrong. I remember watching men in the bucket shops back when I was just a boy learning the tape. I saw them make the same mistake day after day. They'd buy, the stock would tick down, and instead of cutting, they'd double up. They'd say, it's bound to bounce. That's hope talking. Then, on the rare occasion the stock went up for them, they'd snatch a tiny profit at the first sign of hesitation. They were scared stiff of giving back a nickel. That's fear talking. Over time, every last one of those fellows went broke, and not one of them ever admitted it was their own fault. They blamed the game, the tips, the bucket shop itself. But the truth is, they were beaten by their own hope and fear. Hope is dangerous because it makes you blind. When you're hoping, you're no longer looking at the market. You're looking at your wishes. You're not asking, what is the tape telling me? You're asking, what do I want it to tell me? And the market doesn't give a damn what you want. It doesn't even know you exist. The moment you stop reading the facts and start listening to your hopes, you're finished. Fear, on the other hand, is dangerous because it makes you deaf. When you're fearful, you can't hear the truth the market is showing you. You don't trust your own judgment. You think the move is a trick, that it'll turn against you any second. And so you sell. You don't let your winners run, and you rob yourself of the very profits that could cover your losses. I'll ask you something. Which is harder for you, cutting a losing trade or holding on to a winning one? If you answer honestly, you'll see exactly where hope and fear have you by the throat. Most men will say cutting a loser is hardest. That's because it means admitting they were wrong and nobody likes that. But being wrong is part of this business. The market doesn't care about your pride. The sooner you admit a mistake, the smaller it costs you, but hope won't let you. Hope says, don't admit it yet, maybe it'll turn around. And by the time you finally give up, the loss has grown 10 times larger than it needed to be. Now think about the other side. Holding a winner sounds easy, but it isn't. When the money starts to build up, fear creeps in. You picture losing it. You say, better to take a small profit now than risk losing it all later. But that fear keeps you from making the big money. You clip your own wings, and you don't realize that a strong move will keep moving if you let it. I'll give you a personal example. Years ago, I caught a big swing in wheat. Everything in the tape told me it was going higher. I bought and it began to climb. My profits were swelling, and that old feeling of fear crept up. What if it crashes back down? I was tempted to sell, but I'd learned my lesson by then. I forced myself to hold. I reminded myself the market was telling me what it wanted to do, and my job was to listen, not to second guess. That one position paid me more than 100 little trades could, and I wouldn't have had it if I let fear drive me out early. The funny thing about hope and fear is they don't just show up in your trades, they show up in your whole outlook. A hopeful trader always looks for reasons to stay in. He'll read the news, listen to rumors, latch onto any excuse that supports his position. A fearful trader, on the other hand, sees danger in everything. He never trusts his own edge. Both are blind. Both are doomed. The tape is the only truth, and yet hope and fear make men ignore it. Have you ever noticed how, when you're on the wrong side of a trade, the news suddenly seems full of reasons to support your hope? And when you're on the right side, every headline feels like a threat. That isn't the news changing. That's you twisting it to fit your emotions. That's how powerful hope and fear are. They color your whole perception of reality. Most men think they can beat hope and fear by sheer willpower, but they can't. These feelings are too deep, too human. You can't erase them. What you can do is set rules so that hope and fear can't control your actions. Stops are for fear and hope both. A stop tells you when you're wrong, no matter how much you hope otherwise. A stop keeps you in when you're right, no matter how scared you feel. But even with stops, most traders break their own rules. They move them. They cancel them. Why? Because hope and fear whisper louder than discipline. I've said it before, and I'll say it again, the market is a test of character. It isn't a test of knowledge or brains. The smartest men fail because they can't master their own emotions, and the most ordinary fellows succeed because they learn to ignore their feelings and follow their rules. Do you see the irony? It isn't the ticker that beats you. It's yourself. I can't count how many times I've watched a man blow up his account because he refused to take a loss. One more day, one more dollar, one more chance, those are the words of hope. And I've watched just as many men clip themselves out of fortune because they were too scared to sit. Better safe than sorry, they tell themselves, but they're sorrier in the end. That's fear. When you boil it down, hope and fear are just two sides of the same coin, lack of discipline. A disciplined trader doesn't need hope because he follows the tape, and he doesn't give in to fear because he trusts his rules. He knows the market will do what it does, and his job is simply to act accordingly. But tell me, how many traders do you know who actually stick to their own plan? How many times have you sworn you'd never average down, only to do it again when you hoped this time was different? How many times have you promised to let your winners run, only to snatch them off the table the moment fear whispered in your ear? That's the human condition, and that's why 99% fail. Hope and fear don't just ruin trades. They ruin accounts, they ruin careers, and they ruin lives. I've seen men so desperate with hope they pawned their watches to cover margin. I've seen men so eaten by fear they quit the market altogether after one bad swing, even though they had the skill to make it back. Hope and fear are more powerful than skill, more powerful than capital, more powerful than knowledge. And if you don't get them under control, they'll take you down just as surely as if you walked into the bucket shop and handed over your wallet. Most traders don't treat trading like a business, and that's one of the biggest reasons they fail. They treat it like a pastime, a thrill, a gamble, or even a way to escape boredom. But the market isn't a roulette wheel, and it isn't meant to entertain you. It's the most serious business you can ever step into. If you don't run your trading like a business planned, structured, with rules, records, and discipline, you've already stacked the odds against yourself. Think about how a real business operates. A shopkeeper doesn't just throw open the doors and hope customers wander in. He has a plan. He keeps books, he tracks inventory, he watches his profits and losses, he makes adjustments when something doesn't sell. He doesn't stake the whole shop on one crazy deal because he feels lucky. If he did, he wouldn't last a week. Yet that's exactly what most traders do. They jump into the market without a plan, without books, without structure, and then they wonder why they're broke. Ask yourself this: do you treat every trade as if it's part of a business strategy, or do you take it because it feels exciting in the moment? Do you record it, analyze it, evaluate the risk, and measure it against a plan? Or do you just click buy and hope the market rewards you? That one question separates the professional from the amateur. Professionals think like business owners. Amateurs think like gamblers, and gamblers always lose in the end. The funny thing is, most traders don't even realize they're gambling. They'll tell you they're serious, that they've studied charts or read a report. But ask them where their written business plan is. Ask them what their risk budget is for the month, or how they're allocating capital across different opportunities. 9 times out of 10, they'll stare at you like you've asked for the moon. That's because they never thought of it as a business. They thought of it as a way to score, and the market punishes that kind of thinking. Let me tell you something I learned early. When I was young and trading in the bucket shops, I kept meticulous records. I didn't do it for fun. I did it because I knew if I didn't, I'd have no idea what I was really doing. Most of the other fellows in there traded off tips or gut feelings. They weren't running a business. They were chasing a thrill. And they lost everything, day after day. They were no different from the men who played dice in the alley behind the shop. They weren't traders, they were gamblers. And the market always eats gamblers. A business has costs, and a trader's costs are his losses. If you run a store, you accept that some goods will spoil, some customers won't pay, some shipments will be late. You factor those costs in. The same is true in trading. Losses are the cost of doing business. But when a trader doesn't see it as a business, he takes losses personally. He treats them like failures, insults, wounds to his pride. That's when he starts chasing, doubling down, hoping to get it all back in one swing. That's when he goes bust. But a businessman doesn't take a bad shipment personally. He writes it down, learns from it, and moves on. That's what a trader should do too. Now let me ask you, do you keep a balance sheet for your trading? Do you track your returns, your drawdowns, your win rate, your average risk per trade? If you don't, then you're not running a business. You're just dabbling. And dabblers always lose to professionals who treat it with seriousness. You wouldn't expect a restaurant to succeed without knowing its costs and profits. Why would you expect trading to be any different? Another point: trading for excitement is the fastest way to the poorhouse. Too many people think the market is supposed to be thrilling. They want action, like a card game. They don't want to wait, they don't want to plan, they don't want to sit on their hands. They want to feel alive. But a business isn't run on thrills. A business is steady, methodical, often boring. The best trades, the ones that make fortunes, aren't exciting at all. They're calculated, planned, and executed with patience. If you're trading for excitement, you're in the wrong line of work. I've known men who treated trading like a game. They'd come into the office every morning like they were heading to a poker table. They wanted to see some action, to feel the rush of winning and losing. They weren't interested in building wealth steadily over time. They were interested in feeling something right now. And without exception, they all ended up broke. Because the market doesn't pay you for thrills, it punishes you for them. The only excitement in trading should be at the end of the year, when you look at your balance and see the profits. The day-to-day ought to be dull, businesslike, disciplined. Another part of treating it like a business is capital management. A business owner doesn't spend all his cash on one risky product line. He spreads it out, he budgets, he makes sure he has reserves to cover bad months. A trader should be no different. But too many traders put all their eggs in one basket, or they risk money they can't afford to lose. That's not business, that's recklessness. And recklessness is why they fail. Do you know what the real professionals do? They budget their risk like a grocer budgets his supplies. They know how much they can afford to lose this month, this quarter, this year, and they stick to it. If they hit their limit, they stop trading. They wait. They treat it with the same seriousness a shopkeeper treats his ledger. That's why they survive. Documentation is another thing amateurs ignore. Every real business has records, receipts, logs. A trader should have the same. You should be able to look back at every trade and know why you took it, what you risked, what you gained or lost, and what you learned. Without that, you're not learning, you're just guessing over and over again. The men who succeed treat their trading journal like their accountant treats his books. The men who fail don't even bother. Let me ask you something. If you ran a factory, would you shut down the machines and start over every time a product came out imperfect? Of course not. You'd analyze the process, fix what went wrong, and keep running. But that's exactly what most traders do. They blow up their accounts, quit in anger, then come back later without fixing the process. They never learn, because they never treated it like a business to begin with. Another thing about business is they scale carefully. A store doesn't go from one location to 50 overnight. It grows steadily, reinvests its profits, tests the waters. A trader should do the same. Start small, prove your system works, reinvest your winnings, grow carefully. But most traders are in a rush. They want to be rich overnight. They over-leverage, oversize, and overtrade. That's not business growth, that's gambling fever. And the fever always ends the same way. If you talk to any professional who's lasted decades in this game, he'll tell you the same thing. Trading isn't about excitement, or fun, or the rush of the moment. It's about process. It's about sticking to a method, treating it like inventory, keeping track of your books, budgeting your capital, and respecting risk. The amateurs scoff at that. They say it sounds boring. But boring is what makes money in the long run. Exciting is what makes losses. And the reason most traders don't do it is simple: they don't want to. They don't want the responsibility of treating it like a business. They want the thrill of gambling without the grind of bookkeeping. They want the profits without the discipline. They want to play, not to work. And the market doesn't reward players. It rewards workers. It rewards those who put in the effort to run their trading as if it were a serious enterprise, not a Saturday night card game. So when you look at that 99% who fail, you'll see a common thread. They didn't fail because the market was too hard, or because someone had better information, or because the game was rigged against them. They failed because they treated trading like anything but a business. They treated it like entertainment, like gambling, like an escape, and the market has no mercy for men who forget what it really is. Most traders fail because they refuse to adapt. They come into the market with an idea, a method, a pattern, or a belief, and they cling to it no matter what the market shows them. They want the market to behave the way they expect, and when it doesn't, they don't change. They dig in, they fight, and the market steamrolls them. You see, the market is alive. It's not static. It shifts, it breathes, it changes its rhythm. What worked last year may not work this year. What worked yesterday morning may not work in the afternoon. If you can't change with it, if you can't bend, you break. Think about this. Have you ever noticed how traders love to talk about their system? They'll say, "I've got a system that never fails," or "this setup works every time." But no system works every time. No setup lasts forever. The market evolves, and if you don't evolve with it, you're finished. The graveyard of trading is full of men who once thought they had it figured out. They found a pattern, milked it, then kept trying to use it long after it stopped working. They couldn't let go. They couldn't adapt. I've seen it with my own eyes.